Hello and welcome to Bloombergquint, India's first live streaming business news service. I am Agam, Vakil.
And I am Shraddha, Babla. This week on Thank God It's Friday, we're being joined by Jan Dehn, the head of research at Ashmore Investment Management, to help us decode the central bank moves and share his view on India. Thank you for joining us, Jan. Jan, what do you make of the ECB's plan to cut but extend its bond buying program at 30 billion euros a month till next September? How are you reading this number?
Well, this was dovish relative to expectations, particularly the decision to leave open-ended the negative interest rate policy. So he was basically quite explicit, saying that he's not going to raise interest rates as long as QE is being scaled back. And he's going to protect a number of supportive factors in the market, particularly corporate bond purchases. So this was dovish relative to expectations and should keep monetary policy in Europe very easy, even as the European economy is doing quite well right now. So this is actually quite bullish for European stocks and for the European economy.
Jan, there has been much speculation when it comes to the Federal Reserve's next chairperson. How would you peg someone like Janet Yellen as against the other one or two people who are in contention right now?
Actually, I think there's a little bit too much attention being paid to who's going to be the chairman of the FOMC. At the end of the day, I don't think it makes that great a difference. I think the policy direction is quite clear. They are going to be scaling back quantitative easing over the next several years. And in that environment, given how heavy positioning is, particularly in the US stock market and the US dollar, they are going to have to go very, very gently on interest rates. And I don't really think the personality matters as much. It will have a short-term effect on market sentiment, but when the rubber meets the road, so to speak, I think their ability to raise rates ahead of what the market is expecting is extremely limited. The Fed policy is basically going to be to take advantage of short bursts of optimism in the market, where the market proceeds to pricing in a rate hike. The Fed will then say, thank you very much. I will take that rate hike if it's priced in, because if it is priced in, then of course there's no risk associated with it. It's important to understand the backdrop here, that we only really have a few rate hikes on the books. And if we have a recession, historically in recessions, the Fed has cut as much as 5% on interest rates. And we simply don't have enough rates on the books yet to be able to cope with a recession. So until the economy has recovered significantly more and has therefore been able to cope with pricing in more rate hikes, I think whoever is going to be Fed chairperson is not going to be able to hike rates materially ahead of what is expected in the market.
Jan, do you see a divergence between the way the ECB is proceeding and the way the Fed is progressing?
Yes, there is one fundamental difference. The Fed is quite happy to opportunistically raise rates when these rate hikes are priced in, whereas the ECB on that particular point is quite clear. They have no intentions whatsoever of touching rates. And I think ultimately this boils down to a difference in the health of the banking system in the United States compared to in Europe. Europe never recapitalized its banks. There may be a whole bunch of weird things sitting on the balance sheets of European banks as a result of that. And of course, Europe also has a rather weak and heavily indebted periphery. So whereas the United States obviously doesn't. So these two fundamental differences, the European weak periphery and healthier American banks, means that the Fed has a marginal degree of freedom to raise rates, which it will do if the market allows it to, if the market prices in a rate hike, whereas in Europe we're simply not going to get that. Otherwise, the two central banks are actually quite similar. The overall priority is going to be to gradually reverse quantitative easing, and that is really in a bid to try to allow the biggest bubbles we have in global financial system today, namely the US equity bubble and the European fixed income bubble, to gradually be deflated while the economy is picking up, so that when it does become necessary to hike rates because inflation goes up, then it's possible to do so without, in the United States, creating an equity market crash, and in Europe creating a bond market crash. So the whole focus really here is let's hope inflation doesn't show up. let's gradually scale back quantitative easing. And then at some point in the future, when asset prices and the real economy are more closely in line with each other, then it's okay for inflation to show up, because then we can raise rates and we'll have a normal business cycle dynamic.
Well, in this entire interplay between possibly a new Fed chairperson, Donald Trump probably wanting a say, and the rising probability of an interest rate hike in US in December, what does all of this really mean for the US bond yields?
Well, obviously, the US bond yields are going to be moving up. The primary driver of this is actually the economy. We're getting some decent earnings. We're getting some decent growth numbers coming out. Some of the economic indicators are pretty healthy. And of course, there is the prospect in the nearer term of some kind of tax cut, which will stimulate the US economy. That more bullish expectation for US growth is then enabling the stock market to go higher, and then people are selling US Treasury bonds and pushing up yields. And as these yields go up, then the next Fed hike gets priced into the market, and then the Fed says, hey, we're going to hike. So that's kind of what's driving things. I think it's important, though, to take into consideration that actually this tax cut is not going to be a tax reform. It is going to provide a bit of short-term stimulus, but it'll probably have to be financed by increasing amounts of debt. And unfortunately, there is a very close relationship between the amount of debt the government issues relative to the amount of debt in the private economy and productivity growth. Basically, the bigger the fiscal deficits, the more money is taken from the private sector and spent by the government. And because the government's spending is so much less efficient than the private sector spending, this is a key reason for the decline in productivity. And because of the decline in productivity, the long-term interest rate target, so-called R star, that is the interest rate that the Fed hopes to achieve over the long term, well, that actually declines if you increase the amount of government debt, which is probably going to be the outcome of this tax reform. So the bottom line here is that these factors that are driving US Treasury yields higher and the dollar higher right now are likely to be relatively temporary. And I don't think they're going to be a game changer for the US economy. We're not going to wake up tomorrow and find that the US has 4 or 5% productivity growth and so on. So this is an important opportunity for investors to take some profits in the Treasury market, to take some profits at these higher levels for the dollar, and then use this period of relative dollar and Treasury, dollar strength and Treasury weakness to begin to put money into other parts of the global economy where there are better value propositions on offer than in the United States.
So Jan, you spoke about the Treasury markets, but I also want to consider the US equity markets. And we have had some experts opine that they do seem a little overbought right now. Perhaps some have gone on to say that they are in bubble territory. Now, should we see a correction? Now, firstly, I want to know whether or not you agree with that. And if you do, should we see a correction? What would it be that could burst this bubble?
Yeah, there's no doubt that the US equity market is expensive. It is extremely expensive relative to valuations that are on offer in many other parts of the world. And this is really a consequence of the fact that the way the global financial markets chose to trade quantitative easing, which is, of course, the single largest government intervention ever in financial markets, and it particularly benefited the United States. The way the market traded QE was essentially to buy US stocks and the US dollar. And the dollar went up 40% against most other currencies in the world, and the US equity markets tripled in value. But of course, all those inflows led to a feel-good feeling, but actually there have been very little reform. US government debt has gone up, the dollar is overvalued, and as you point out, stock markets are rather expensive. And the real concern here is that as quantitative easing, which has ultimately been the primary driver that has caused so much money to flow into the equity market, as quantitative easing is now being scaled back, people are going to ask themselves, okay, I made a lot of money in the past 5 years trading this quantitative easing wave, but what is the outlook for the next 5 years? Am I really going to make as much money as quantitative easing is being scaled back, as monetary tightening is gradually taking hold in the United States? And I think that's an important potential source of risk, because I would expect that the equity market will make incrementally smaller and smaller gains as the intervention from central banks is diminished over time. The other factor that worries me a little bit is that you're seeing such a big divergence between the performance of a small number of tech companies, Amazon, for example, whose business models are working out really well, and then the rest of the equity market, which is not doing nearly as well. So we're really sort of seeing that it's not so much a broad-based acceleration anymore. It is more beginning to look a little bit like a single sector that is driving everything. And of course, ultimately, that's not such a healthy development. So I think we could see a pullback in the stock market quite easily. I think it would mainly be driven by simply profit-taking or valuations becoming excessive. For example, once the tax cut has been fully priced in, once we've had the rate hike, and once we've had some profit-taking in the rest of the world after a reasonably good year in Europe and emerging markets, for example, this year, we should see some profit-taking now, and that means money going into the US. But that looks more like a sort of a dynamic that plays out for the rest of this year. And I think once we get into next year and people say, well, so what has really changed and what is now priced in? Well, then I think the US equity market will once again start looking extremely expensive. And I think there will be strong incentives for investors to start pulling money into other parts of the world. And that could certainly lead to a pullback in the equity market.
And do you believe that with this unwinding that two of the major central banks are headed towards, have emerging markets priced in this unwinding, or are we likely to see more volatility as we head closer to December?
No, I think the unwinding of quantitative easing is going to be extremely bullish for emerging markets. There was a perception early on when quantitative easing began that because it would drive down bond yields in developed markets, that there would be a search for spread, a search for yield, and that would then lead to a whole bunch of money flowing into EM. But of course, as we've seen in the period from 2013 through 2015, we had 3 years of extraordinarily large outflows. And the reason why quantitative easing had this perhaps counterintuitive effect was because investors chose not really to look at yield differentials in developed markets and EM, which is what the original thought was. Rather, what people looked at were capital gains. And the capital gains in the QE-sponsored markets were absolutely enormous. US equities tripled in value, the dollar went up 40%, and in German 30-year bonds, for example, people made more than 70% return. So in light of these enormous capital gains, investors were saying, why should I have my money in 7% government bond yields in India or in 9% government bond yields in Ecuador? It was not really about yield, it was all about capital gain. And the interesting thing now, as we begin to see the scaling back of quantitative easing, is that in developed markets, both in bonds and equities, people will then ask themselves, okay, am I really going to make capital gains anymore? And the answer is probably no. You're not going to make nearly as much capital gain as you've done before. And meanwhile, valuations are so high that you're not going to get any carry either. So there are only two ways of making money, capital gain or yield. And if you don't get any yield and you're probably not going to get as many capital gains, the question is where are you going to get your returns at all? Meanwhile, in emerging markets, because so much money left emerging markets, that pushed up bond yields and actually led to capital losses. But we're now in a position where we can offer both capital gains and high yield within emerging markets. So I think that the unwinding of quantitative easing is going to be positive for emerging markets. I think we're going to see more flows coming back into the non-QE sponsored world because it simply has a much, much more attractive value proposition.
All right. So then, where does India stand in terms of attractiveness vis-a-vis its emerging market peers?
India is in a complex situation because the Indian market is obviously quite expensive, and we're looking at a 12-month forward price-earnings ratio in Indian equities of about 18, and I think the earnings per share that's priced in for the fiscal year 2019 is somewhere in the region of 22 to 23%. This is expensive. It's almost as expensive as the US equity market. And it's quite expensive compared to the MSCI EM in general and frontier markets in EM. So India looks expensive. In addition to that, there are some near-term issues, particularly the prospect of more expansionary fiscal policy. The government has announced significant amounts of infrastructure investment. And of course, we've had the very important announcement of public sector bank recapitalization. In addition to that, we have some near-term implementation problems with GST. The market is likely to look at these short-term events and think, hey, wait a minute, if we're going to have a lot more supply of government bonds, then yields might go a little bit higher in the bond market. And given where valuations are, that's actually, in the short term, a bit of a negative. However, I would argue that you should really look through these short-term effects. Clearly, more infrastructure spending in India is an excellent idea. India does need a lot more infrastructure investment. And the whole idea of recapitalizing public sector banks is an extremely good piece of news, because one of the reasons why the economy has not reacted even more strongly to the reforms that have been done in India is precisely because a large part of the banking system is sitting on non-performing loans and is a drag on the economy. And finally, GST, well, yes, there are teething problems, but the government is clearly showing that it is responding to these teething problems, and I think these effects will fade. So in a sense, we have a situation here where there is an improving and strengthening medium-term outlook for India against the backdrop of some very expensive stocks. So how do you handle that particular combination? I would suggest that you go back to basics and that you go for value. I like industrials, I like infrastructure. I would take a closer look at the PSU banks, particularly as we start seeing how much government will try to influence the management of these banks. And then I would keep away from some of the stocks that are really very expensive now, like financials and consumer stocks. I do believe that the Indian outlook is getting better, but we have a little hurdle to get over. And I think the best way to do that is to sort of look into the transport, construction, industrials. I think that's where the real value lies, and that's where you have the biggest gains, if I'm right, that over the sort of next year or so, we'll begin to see the benefits coming through from these longer-term reforms that the government is doing.
Okay, Jan, so you did speak about the pros and cons of investing in Indian markets, and you also gave us a little bit of an idea about what sectors look better in comparison to some others which don't as much. But, you know, FII flows in the last couple of months have been extremely tepid. By that I mean foreign institutions. So do you think that it's a wait and watch that they are taking up right now before they move in and you know, put in some money? And in that case, can we not rule out a correction because of that?
No, we definitely can't rule out a correction, and I'd be surprised if we don't see one. And in fact, we're already seeing one as far as emerging markets are concerned. We're already seeing one right now. We've had 18 months of extremely strong performance. EM equities are up 40% in dollar terms in the last 18 months. Local currency bonds in emerging markets are up something in the region of 20% in dollar terms in the last 18 months. So very, very strong performance. And against such a strong performance, you are seeing a pullback now. Investors are taking profits. We're going into the fourth quarter. People often don't like to put risk on in the final quarter of the year. But in terms of the pullback from international investors in India, that's actually an India-specific event. And that's because investors have historically been conditioned to look at fiscal spending as the big danger signal in India. Under the Congress administration, of course, fiscal policy got completely out of control, both at the central government level, but also in the quasi-fiscal deficit through the public sector banks. And that has been improved. And I don't think it's right, actually, for people to be too worried about the fiscal picture here in India, because we know what the fiscal spending is going on. We know it's going on infrastructure, and we know it's going on bank recapitalization, both of which are actually very, very good for India in the long term. But because India is expensive and because investors have this habitual way of looking at fiscal spending, they're sort of pulling a bit of money out of India. Actually, in the rest of EM, third quarter was a quarter of very, very strong inflows. And I think there are very good reasons to expect significant increases in foreign flows into emerging markets, including India, particularly as we go into next year. Because there is this curious lag behavior between when a market begins to turn decisively and when big institutional investors respond. Typically, if you take, for example, US pension funds, they will be advised by consultants. once there's been a big turning point in the market, which as far as EM is concerned was really at the end of the first quarter 2016, it'll take about a year for consultants to really gain sufficient conviction to think there's been a turning point in the market. They will then advise pension funds to allocate. The pension funds then have to go through a sequence of steps, including board approval, searching for managers, finals pitches, and then writing contracts before they can allocate. And typically this delay is somewhere in the region of 18 months between when the market turns and when these institutional flows come in. And that's exactly what we saw. In the third quarter 2017, we saw very material institutional inflows to EM. So far, only 1/3 of the money that left has come back. But nevertheless, the flow has begun. And I think that flow is going to take a little pause in the fourth quarter for all the reasons that we're familiar with. We like to take profits in the fourth quarter and so on. But as we get into next year, I think we are going to do so with a background of very solid double-digit returns in both local currency bonds and in local currency equities in emerging markets. And investors are, generally speaking, still extremely light. And the outlook in those markets are materially better than the outlook in developed markets as we go into the next few years with quantitative easing being scaled back. So India should expect significant inflows from institutional investors as we get into 2018.
Jan, it's interesting that you spoke about fiscal spending in India specifically, and we wanted to know, from your conversations with investors across, do you think that reforms will now take a backseat for this current government as they move into the race for the elections in 2019?
Yes, and I have to admit that I was amazed, that I was quite surprised at the announcement of public sector recapitalization of the banks. I had really not expected this to happen before as we head into the election season. But it's a very, very good piece of news. I think this will be the last major reform that we're going to see before the election season. But I hadn't expected it to happen, to be honest with you. I'm very positively surprised. It has two important implications. First of all, if you can sort out the banking sector mess, recapitalize public sector banks, then you're going to see a much brighter outlook for credit growth, particularly for households and for corporates. And given the reforms that have already taken place in India, we should see a significant response from the banking sector and a growth in spending both at corporate level and household level in response to stronger banks. So that's the first point. And of course, that's not entirely unhelpful as we go into an election. We actually start seeing some of the benefits of the reforms. The second very interesting aspect of bank recapitalization is, of course, that it has the insolvency of a number of public sector banks has been one of the primary arguments for not opening the bond market in India to foreign investors. When you have very weak banks, which have to be market makers, and then you have foreign investors coming in, then that becomes a very vulnerable part of the entire banking sector. With stronger banks, I think one of the last arguments for still maintaining quotas and capital controls for foreign investment in bond markets in India really goes away. And then we're really just down to a small group, a lobby group that doesn't want the competition from foreign investors. But if Modi is really serious about making India and about opening India and making India more competitive, clearly he also needs to open the bond market to more foreign participation. And that's why I really like the whole public sector bank recapitalization. It opens the possibility that happens. Other than that, I really don't expect any more major reforms from India, but before the election round. But let's be fair. I mean, Modi has done a lot, and a lot more than many other governments have done in such a short period. So the building blocks are definitely in place for a sustained strong growth performance in India over many, many years to come.
Jan, just the last question. What have you done with your Indian portfolio holdings? Because the last time we checked, you had exposure to some of these private banks like Axis Bank and HDFC Bank, and you have spoken about the banking sector in India and also the auto major Maruti. Have you found opportunities to add as far as the Indian portfolio is concerned, or have you reduced your exposure?
No, we've changed our allocation. We have gone now for the deep value stuff, in the industrial sector, in transportation, in construction, some beaten up pharma, some mid-cap IT companies where we really see quite deep value now. And we have scaled back our exposure to the cyclicals. We've scaled back our exposure to large cap IT. We've scaled back our exposure to consumer stocks and financials. So the very sort of cyclically dynamic sectors we've now reduced our exposure to and gone for the deep value more on the industrial side of the stock market. And that simply reflects that we have this valuation, this problem with very high valuations and a little bit of headwinds as these undoubtedly very good policy initiatives like infrastructure and bank recapitalization and GST gets implemented. So while you have that little transition period until the fruits of reform begin to really manifest themselves, I think this is a good time to take some profits in some of the cyclically sensitive shares and then going into the real deep value stuff in the real economy, which I think ultimately offers the best value as we start realizing the medium term very bullish prospects for the Indian economy.
Jan, there is just one more question that I need to add before we let you go. It is about the Indian monetary policy cycle reaching its end. Do you think that is coming to be, or do you think we're a long way from it?
No, I do think we are drawing to a close here. I think the RBI is just as focused on the on this dilemma of big fiscal policy stimulus. And how it might impact interest rates, how it might impact the currency and foreign investor sentiment vis-a-vis the likely long-term benefits. And I think the RBI will have to be much more mindful of the short-term effects. And we, of course, have seen inflation creep up a little bit. We've seen a current account deficit widen a little bit because of higher oil prices. And so there are some signs here that the RBI is absorbing, and it's therefore holding back on cutting rates. And I think that's the right policy. We always want the Reserve Bank to err on the side of caution. There's enough opportunity in the Indian economy that we don't have to fuel markets purely with rate cuts, especially if there are risks. There's enough opportunity, entrepreneurship, and value across the different components of the Indian economy that you can make money even without having to artificially stimulate through excessive rate cuts. So I expect the RBI to remain prudent and conservative, and I don't see a lot of room for rate cuts going forward.
Well, the RBI must err on the side of caution, and with a whole host of takeaways, not just from Indian markets, but also from the global markets. Jan Dehn, it was a pleasure speaking with you. Thank you very much for your time.
Thanks so much. I appreciate it too.